people up until that point had lived through a number of business cycles in their career, typical expansions, which are met by Fed tightening, which then create reversals in the economy, which lead to eventual stimulation and reflation. And at that time, it's kind of hard to believe, but when you were standing in 2007 or 2008, I think there were real questions about, are we seeing a recession or are we seeing something different than a recession? And I think part of the key focus that we had at the time was building out that understanding and frankly helping educate others on being able to differentiate a traditional business cycle, which can be reversed, where the economy can be reversed using monetary stimulation, typical, interest rate cuts, et cetera, from something that was actually going on, which was a deleveraging environment, which is where people had, and in particular, U.S. households, had borrowed too much money relative to their incomes, which created a need to cut their borrowing, which created a cut in spending, which then created the bigger second and third order problems, which is it created forced liquidation of assets and that downward forced disinflation or deflationary spiral of very quickly and abruptly paying down debt. And the dynamic of how to solve that sort of cycle, you're going to cut interest rates to zero. That kind of looks like a traditional business cycle, but typically cuts to zero aren't good enough to actually reverse that process. You have to do more in terms of monetary stimulation. And so that, whether it's, back in the 30s, devaluing the dollar relative to gold, or whether it was more recently printing money and buying assets in order to reflate the economy, we knew that was the path that we had to go down. I think another important dynamic was that much of the market didn't fully appreciate the stress that sort of deleveraging dynamic puts on the financial institutions, and in particular the banks. And so we were very forward-looking in saying you had to be out there recapitalizing the banks. And in fact, I can remember directly counseling the government on crafting the TARP legislation to allow for bank equity to be included as part of that rather than just traditional asset purchases. And that was really critical, because the beautiful thing about recapitalizing banks is banks are levered entities. And so you get a lot more bang for your buck in terms of offsetting the deleveraging pressure if you can capitalize banking institutions. And so all of that were things that had existed in the 1930s, but people hadn't really thought we were in a traditional recession and kind of missed that dynamic. And so it was really critical to understand we were in a deleveraging, not a recession, and the tools to meet that deleveraging were very different. And frankly, the tools that ultimately were used by the Fed and the Treasury and Congress to help create the reversal in the economy, which, all things considered, was pretty fast. The economy kind of went down in September meaningfully, and by March we had bottomed and started the reflationary process. And so, that was a pretty good response, all things considered, relative to how deleveragings in the past had been handled.